I'm Sabrina.
I'm Amy.
I'm Brian.
And we're pitching, again, the stock TechTarget.
Just to give you kind of an update on some follow-up that was asked and kind of remind you who they are.
Yes. And so we chose a stock because we're looking for that in the communications industry with extremely high growth. And TechTarget is an American company which offers data-driven marketing services to business technology vendors. Last time we were confused, but they're definitely just business to business. It uses purchase intent data gleaned from the readerships of its 140 plus technology-focused websites to help tech vendors reach buyers actively researching relevant IT products and services. And our customers, main focus business to business, new venture capital startups, and IT vendors. And here is like some of their customers that they use.
So these are the marketing categories that TechTarget talks about. Each of these categories is where they segregate their different websites. So each of these categories has a bunch of websites in which they gather data. So their main business products can be broken into two different categories. They have the IT deal alert, and that's where their priority engine product falls in. And that's where they take purchase intent data from IT consumers, and they charge IT vendors a subscription to view and use that information. They also have what they call the core online section, and that consists of demand solutions, brand solutions, and custom content creation. So the custom content creation is where a group of vendors will go to them and need specific information for a marketing campaign, and they will compile a report for that specific reason. Brand solutions is where they help companies get their brand exposure, which is creating a website, embedding a website in one of their websites, or offering them advertising on their pages. And demand solutions is where they help them come up with the best way to reach customers through marketing campaigns. So TechTarget's traffic, they market to IT vendors by targeting audiences who are actively looking for purchasing decisions. So their primary source of traffic is non-paid traffic, and that consists of 97%. And they generate revenue off ads on their websites from this. When you go to their websites, they'll often, to view certain content, they'll make you register to view certain content, which is where they get their register base from. And the secondary source of traffic is through marketing expenditures. So occasionally they will do a keyword search on major search engines, and they will also get lists of opt-in email addresses and reach out to people that way. And we can see that their subscription revenue is projected to go up, mainly because of updates to the priority engine and companies wanting to subscribe long term to that.
So we wanted to reiterate why you should invest in TechTarget. The biggest one is that there is a lot of IT growth in the economy in general. Increased information technology affects every company. The second is that TechTarget has substantial growth compared to its competitors and is definitely gaining a lot from this boom in the economy in IT investment. And also TechTarget especially boasts themselves that they have better audience insights, targeting capabilities, and performance than competitors. So the first point, just to show these graphs again, is the increased IT spending from 2016 to 18, as well as the data and analytics spend from 2017 projected into 2020. And these, looking at where the data came from a John David Lovelock research of part of Gartner and Forrester, which actually TechTarget does identify as their two biggest competitors. So TechTarget themselves have had great growth over the past couple of years in revenue, adjusted EBITDA, and then also within the adjusted EBITDA margin, just to show you the graphs and how they look so great. And then why TechTarget? TechTarget talks a lot about its better audience insights. So they rely on first-party insights, their own proprietary information, so they can see a lot of buyers that other people miss. They also say they have better targeting capabilities. That is part of the priority engine, and using the opt-in mailing list to target people when it matters. They can see when someone's looking for it and get it to them so they don't have to keep searching. Part of the Google keyword search is that they always end up on the first page of Google, so you never have to go past. They also create better performance through repetition. It's been shown that if a person is more likely to click on an email from a company if they've seen the advertisement for that company elsewhere beforehand. They also have better performance. Their year-over-year click-through performance continues to improve. It's now 150 times better than the industry average. As well, they boast 700% more effective at back-end engagements, such as interacting with people on their websites, than other data providers at 6 times lower the cost of engagement. So they believe that they can interact more efficiently and more effectively than their competitors. We did, for this graph, we focused more on their competitors instead of comparables. Previously we had Expedia, which just didn't do the exact same thing. So we added in QuinStreet, which is a similar market cap, as well as Forrester and J2 Global. We also changed a couple of the metrics. We added in current ratio, which helps show their liquidity. TechTarget has the best ratio out of all of them, as well as their 1-year revenue growth, which TechTarget doesn't have the highest revenue growth compared to some of these other competitors, but for Tesla and Gartner, considering their market cap was in the billions instead of 600 million, we didn't think that it made TechTarget look bad. It just showed that it's more comparable to its own market cap company.
Sorry, a couple of questions. So, it sounds like they have a lot of liquidity on the books. Has TechTarget made any acquisitions, or has it grown organically in the past? Because one reason why companies sometimes run up their cash balances is because they're about to make an acquisition.
They have not had any acquisitions at all. So I didn't see anything that suggested they have an acquisition in mind. They're pretty focused on growing organically. It could be because of their priority engine. That's something that they've been working on, so they might have been building up to spend it.
And one thing they mentioned too is since there's a lot of overlap in their programs, they do see in the future years that they could blend a lot of their programs together and reduce the number of products they offer.
One other question, not quite related to this, but you mentioned a few different revenue streams they had, like advertising, subscription, etc. Like, do they break out their revenues by source?
Not that we were able to find so specifically. Every once in a while they'll talk about it, but we weren't able to find anything that was specifically like, this is ad, this is membership, this is X.
Okey-doke, keep going.
So we wanted to include a new graph with the communications sector, the S&P 500 and TechTarget. Communications is a little interesting. The reason why it's so close to S&P 500 is because it's a fairly new sector. It used to be part of another one. But TechTarget did go below these kind of comparable lines in 2019 at the beginning, but so did many other companies. And now it's back up over top of it. So we also changed our evaluation method a little bit. We excluded free cash flow to the firm and only kept free cash flow to equity because they do not have varying debt levels. We also added in a relative valuation of PE with a 2019 estimate. We felt we wanted to put that in just about 10% to give it some weight into the future, since all the PEs dropped down a considerable amount, but we felt like it was not as important as the historical PEs. This gave us a target price of $30.32. The PEs are from our competitive comparable companies.
Okay. Questions from the class? More questions. I'll give you the, I think you guys did a good job of addressing the questions from last time. So, you know, put together your 2-minute, like, this is why you gotta invest in TechTarget for not next class after, Tuesday. And catalysts, so same question, kind of goes like the tech industry, like you guys had lots of stats about how the tech industry is growing, so when are people going to recognize the value in this stock? Like, what is it that's going to change?
Okay, so like one point, not just in
Is
general.
there something, well, so you can look at catalysts a lot of different ways, but if you come up with a discrepancy between the price a stock is currently trading at and what you think it's worth, which you guys did, then the question is, when do these prices converge, or how do they converge? What causes them to converge? That's what a catalyst is. It can be an external factor. It can be something like, you know, TechTarget is investing a lot in this new like search engine product and search product, and then like that will like come out, and we think investors will see that and like recognize the growth. It could be a lot of different things, but you should have some reason why you think these prices are going to converge. Does that help? Okay. What are you guys thinking about your sale recommendations?
We are thinking about selling conduit because it's doing pretty dang awful. But because it has so much, it is such a low position value, we were gonna ask about using the cash that we have as well. But we wanted to check with you on whether the cash lives there on purpose or not.
There's not the current cash balance is extremely low. It's like $5,000.
Okay, because that conduit is only about $19,000 or $2,000, $1,900. So we thought added in $7,000. We weren't sure how low,
So
how much money to use.
I
do
would
think
say
we sell
you can make the recommendation to sell conduit. I would probably suggest selling a second position as well. We do, so we're not allowed to carry more than 5% of our portfolio in cash, but I think we also have a minimum balance. Plus, by the end of the year, we need to have a certain amount in cash to pay out scholarships, or like by spring, a certain amount in cash. So even if you combine those two things, that cash amount would be pretty small, or like that amount would be pretty small, and so basically no.
Okay. That's fine.
Pick something else to sell as
Gotcha.
well. Thank you. Judy and Haley, do you have thoughts on what you might want to sell?
Looking at floor and canopy growth.
So you guys are all picking companies that are like, have kind of been losers in the portfolio, and we kind of talked about that last class. So I would probably do a little bit of research to be like, why did this stock not appreciate, you know, what went wrong? Like, why didn't it perform as predicted? And is there anything that you think is going to turn, like, is there any reason to give the stock a second chance? Like, if we still have conviction in the original stock thesis that maybe this is just a temporary correction and it may turn around, then it might still be worth holding. But if we're like, no, things have changed, never gonna be the same,